Hello, options traders. Good morning once again. And one of my favorite topics in options is about the big risk of taking small profits. So, the reason I like to address this is that if you listen to kind of the conventional wisdom among a lot of traders, they're going to tell you that you got to get in and get out. You got to take these very quick profits. And it sounds good on paper because the belief is once you lock in the profit, it can't be taken away. And in fact, they often cite one of the worst quotes ever is that you can't go broke taking a profit, which is absolutely not true, as I'm going to show you here. So, what is the big risk of taking small profits? Let's go have a look. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So, this whole concept of having a big risk by taking small profits rests on the idea of fair value. And we've talked about this in many previous videos. But recall that fair value is a mathematical concept. And what it means is that it's a price that doesn't favor the buyer or the seller. In other words, over the long run, buyers and sellers are expected to just break even. So fair value is also a long run concept. Even if you're playing a fairly valued game, you can absolutely lose in the short run or even over extended periods. So we're really talking about extremely long periods of time that you're expected to just break even. So a simple example that I use a lot is to bet a dollar to win a dollar at the flip of a coin. So if there's a 50% chance of winning, you should be willing to bet $1 to win $1 at the flip of a coin. And this would be a fairly valued bet. So if we did this, let's say 500 times, this might be one of the sequences we would get. Now, 500 flips isn't by any stretch a long run, but in this case, we did come right back to zero. See, here's our profits above zero, above this horizontal line. Here's the losses. So you can see over some stretches, we definitely got some gains all through here. But in some stretches, we ended up with some losses. Ended up with some pretty big ones over here for an extended period of time. But overall, if you just look over time, looking at the far left side to the far right side, we just went sideways. That's an indication of a fairly valued bet. So again, it's fair to the buyer and the seller. Now, let's turn this around and ask, well, why is $1 fair value? I gave you a quick description of it, but why can we say that $1 is the fair value for a coin flip? Well, now we can say a coin has a 50% chance of coming up heads or tails. So you have a 50% chance to win, in this case, $1. That was the bet. So the expected reward would be the 50% probability times the $1 reward is 50 cents. And so if you have a 50% chance to win, you have a 50% chance to lose. And therefore you should bet the 50-cent reward divided by this 50% probability would equal $1. And we're right back to where we started. You should bet $1 to win $1. Now, we could also look at this from a different angle. If somebody approaches you and just says, I've got a game where you can bet $1 to win $1, well, is that a fairly valued game? So let's say that somebody approaches you and says, I've got a game where you can bet $1 to win $1. Well, is that a fairly valued bet? What we can do here is to calculate the implied probability. In other words, if this is a fair bet, what would the probability have to be in order to make it fair? So to do that, we're going to take the $1 that you have to bet divided by the amount you have to bet plus the amount you could lose. So divided by 1 plus 1, and that turns out to be 1 divided by 2, and we come right back to a 50% probability. So if we look back and say, well, yeah, that sounds fair. Coins come up about half the time, heads and tails. So betting $1 to win $1 would be a fairly valued bet. All right, so those are a couple of ways that we can figure out either the fair value of a bet or for any given bet, what the implied probabilities would be. So let's come back to this whole concept of small profits. Again, it sounds really good on paper to just take those really quick profits when they're staring you in the face. And people like to say, oh, but I made 10% in a month or 120% per year. And that's even more encouraging to take them. So let's say that you buy the $100 call and you spend $9 and you turn around and you sell it for $1. and you say, hey, I can't go broke taking a profit. I've got this guaranteed profit. And that's part of the lure too. People think that because you've locked in this profit, that somehow it can't be taken away. Well, that's not true. Presumably, you are going to do additional trades in the future. And if you keep making these bad trades, it's only a matter of time before the probabilities catch up to you. So let's say that you took this trade right here. We can look at it as a bet that you bet $9 and you collected $1. Now, I know for the purists out there, they're going to say this isn't exactly like a coin flip. It's not a binary event. There are other rewards you could win. And that's absolutely true, but it's still just to make a point. So if you took this as a bet where you could bet $9 and you're willing to accept $1, what are the implied probabilities? Well, we just saw you have to take the amount that you're betting, 9, divided by the amount that you're betting, plus the amount that you could win. So 9 divided by 9 plus 1, that's 9 over 10. That implies that you must have had a 90% chance to win. Otherwise, it's not a fairly valued bet. So we can back into this and say, well, if there's a 90% chance of winning $1, the expected value would be 90 cents. And if there's therefore a 10% probability of losing $9, then that would be 90 cents. And you can see that now it's a fairly valued bet. You are mathematically effectively betting 90 cents to win 90 cents once we account for the weights. And so this would be another way to show that it's a fairly valued bet. But now for the big disclaimer. The assumption then, by paying 9 and selling for 1, is that you have a 90% chance to win. And no option trade is going to have a 90% chance to win. All right, so remember that we have a bell curve sitting over the current stock price. Half the time the stock's going to be to the right, half the time it'll be to the left. Pick your time period. That's always going to be true. And if we overlay it with, let's say, a $100 call, with the stock at 100, we have about a 50-50 shot of making money. But what if the stock is way up here? We've got the $100 call, but maybe the stock is up here at 120. Doesn't matter. The bell curve is always over the current stock price. So yes, you've got a lot of intrinsic value, but it only takes one downtick of the stock to now put you into losses. You're still facing roughly a 50-50 shot of losing money. Now again, don't confuse this to mean that you have a lower probability of intrinsic value. There's no doubt if you have a in-the-money option, especially deep in the money, you've got a very high probability for that option to expire in the money with intrinsic value. But that does not mean profitably. And this is why. The bell curve is always over the current stock price. So pick your option. It doesn't matter. You certainly don't have a 90% chance of winning. And yet that's effectively what traders are doing when they spend a lot for an option, but clip it for a very small profit. So this whole problem with taking small profits comes down to the idea of expected values and of fair value. So going back to the example that we saw where you're going to pay 9 and take a very quick profit, let's say for $1, implies that there's a 90% probability. But we just showed that it's probably closer to 50-50 for winning or losing. So look what's happening. If your reward has a 50% chance of occurring, the expected value is 50 cents. If the loss has a 50% chance of occurring, that's an expected value of 450. So in the long run, you would be losing 450 for every time that you banked 50 cents. And you can see that that is absolutely a long-run disaster, even though it sounds good on paper that you're taking very quick profits. So what's the solution? This is where you have to understand your hedges, rolls, and morphs. Learn to stay in the position and make lots of money, all while hedging the downside risk. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.